Today we talk about technical analysis theory is always right about the market trading. So what do I mean by that? First of all, most traders they use either technical analysis or fundamental or combined. So now, if we look at any market behavior and something happened to the market, whether it is stock, currency, or commodity, and if we look back, we can always find explanation to why the market behaved that way. That is, on the hindsight, that after the market have completed its action, then we can use technical analysis theory to explain. There are many technical analysis theory in terms of tools, be it Fibonacci, Andrew Pickford, classic behavioral pattern, candlestick, etc. So, when the market has completed its pattern, you can always find one of those theory, whether it's candlestick or whether using the MACD indicator to explain. So this is what I mean by technical analysis theory is always right. But the challenge is, before the market complete its pattern, how do we know that the next market movement will move using which technical analysis theory? Is it Fibonacci or is it Elliott wave? That itself is a challenge. But now we look at it this way now. If we can explain all the market behavior on the hindsight, that is after the market has completed its pattern by the use of technical analysis, then there is something to this technical analysis tool that we can use for our trading decision. At this juncture, I like to make a comparison with fundamental. In several cases, you can also use some fundamental to explain the market behavior. For example, certain stock that there is news about that company has just get confirmation of a large contract from the government and the price shoot up. However, there are so many fundamental news. For example, the Federal Reserve, the interest rate hike, etc., etc. So it is impossible to have a group of information or market analysis using fundamental to explain all the market behavior. So in this respect, I would prefer to use the technical analysis because it is a set of theory with the tools, and depending on how we use the tool effectively, we have a better chance to see the market behavior now, past, or possibly the future. So the question is, or the challenge is, before the market completed its pattern, which can affect our trading performance, losing money or making money, which of the technical analysis tool should be used? And that is the biggest challenge. But just bear in mind, what I like to propose is, technical analysis theory is always right, meaning you can use that theory to explain. Sometimes you can explain it by Fibonacci, another time you can explain by Elliott wave. So in this respect, I find it challenging to study the various types of technical analysis tools, and to practice, I hope to gather more useful tool to be used at a particular time. That's all for today's sharing.